The price of gold just moved past the $5,000 barrier. For some, this was unexpected. But for those watching the long-term trends in our financial system, it felt inevitable. This isn't a temporary price spike. It's a signal that the ground beneath our financial world is shifting. In the next few minutes, we will examine the three core forces driving this surge and why a gold price of $5,000 may be just the beginning. We'll explore the geopolitical friction reshaping global finance, the structural weakness of the US dollar, and the historic gold buying by the world's central banks. Most importantly, you will understand what this means for the long-term security of assets. The rules of finance are being rewritten. Gold's surge of over 60% in 2025, one of its largest annual gains since the 1970s, was not a conclusion. It was the start of a fundamental shift. History offers a clear message, and today we analyze what it says. First, the most significant driver: geopolitical friction. The post-Cold War global order is fracturing, leading to what economic leaders identify as a primary risk: geoeconomic confrontation. Think of gold as a barometer for global confidence. When trust in international stability erodes, capital seeks not promises, but a hard asset that has preserved wealth for centuries. Right now, that barometer is indicating high pressure. This is a primary reason for gold's ascent. In 2025, gold reached over 50 all-time highs, not from a single crisis, but from a persistent series of them. Every trade dispute and regional conflict now adds a geopolitical risk premium to gold. We are in an environment where a headline about tariffs can influence markets more than traditional economic data. This creates a feedback loop. Rising tensions lead to consumer and business hesitation, which slows global growth. Governments then respond with accommodative policies, which can fuel more uncertainty and increase the demand for gold as a store of value. This is a force moving billions. The world's largest institutions are systematically diversifying away from what was once the safest asset on Earth, U.S. government debt, and into gold. This marks a fundamental shift in how nations perceive risk and safety in the 21st century. This instability has become a primary driver for the gold price, but it's amplified by the decay of the one asset the world has long trusted above all else. The second and perhaps most powerful engine behind this rally is the structural weakness of the US dollar. For over 70 years, the dollar has been the world's undisputed reserve currency. That position is now being challenged. You've heard the term de-dollarization. It is no longer a fringe theory, it is an active trend. The US dollar's share of global reserves has fallen to a multi-decade low of below 60%. Nations are actively diversifying their holdings, and gold is a primary choice. The reason is a steady erosion of trust. First, the US national debt has surpassed $38 trillion. This poses a direct threat to the dollar's long-term value. Each new trillion in debt can dilute the value of existing dollars. Many analysts view this as currency debasement, and gold has historically served as a hedge against it. The dynamic between gold and the dollar is a matter of trust. Second, the weaponization of the dollar through sanctions served as a global wake-up call. When countries saw the foreign reserves of other nations frozen, they realized holding dollars carries political risk. Gold, in contrast, cannot be unilaterally canceled or controlled by a single government. This dollar weakness has a direct mechanical impact on gold. Since gold is priced in dollars, a weaker dollar makes it more affordable for buyers holding other currencies, which can fuel international demand. In early 2026, the US dollar index hovered near multi-month lows after one of its weakest years. The era of unchallenged dollar dominance is evolving. The dollar's shifting role is creating a vacuum. And now we see the world's largest financial players moving to fill it with something much older. The third factor that defines this gold rally is the relentless, record-breaking buying from the world's central banks. This is the smart money on a global scale, and their actions are a powerful signal. They are acquiring gold at a pace not seen in over 50 years. The numbers are significant. Since 2022, central banks have more than doubled their pace of gold purchases. Even as prices reach new records, their buying has not slowed, it has accelerated. In November 2025 alone, central banks added a net 45 tons to their reserves. Projections for 2026 suggest they could acquire another 755 tons, far above the previous averages of 400 to 500 tons per year. This is a sustained, strategic pivot. The buyers are diverse and global. The National Bank of Poland added 12 tons in a single month, bringing its gold holdings to nearly 28% of its total reserves. The Central Bank of Brazil is on a buying streak. China, India, and Turkey are also major accumulators. They are all taking these actions to insulate themselves from geopolitical risk and diversify away from the US dollar, building a new layer of their financial foundation with gold. This demand is so strong and price insensitive that it has created a solid price floor for gold. While short-term traders might sell for a quick profit, central banks are accumulating for the long term. When the world's largest financial players all seek to acquire the same finite asset, the price has only one direction to go. This sustained institutional buying creates a price floor. At the same time, concerns are growing about valuations in other asset classes, leading investors to reconsider where true value lies. There's a fourth storm brewing, the growing concern about an everything bubble. Years of low interest rates and monetary stimulus have inflated the prices of nearly every asset, from stocks and real estate to the current frenzy in artificial intelligence. The S&P 500's performance in 2025 was largely driven by a handful of mega-cap tech stocks tied to AI. The International Monetary Fund's chief economist has even warned of a potential bubble in certain AI-related investments. When such language is used by major financial institutions, it signals a need for caution. Investors see stock markets near all-time highs, fueled by specific trends, and they recall the dot-com bust and the 2008 financial crisis. They are beginning to ask, what is the underlying value here? In this environment, gold's appeal is its simplicity. It is a real, tangible asset. It doesn't rely on future earnings promises or a new tech breakthrough. In 2025, gold-backed exchange-traded funds, ETFs, saw record-breaking inflows of $89 billion, pushing their total holdings to a historic 4,025 tons. After years of outflows, investors are returning, signaling a major strategy shift among large institutions. In a financial system characterized by high liquidity, gold can act as a hedge against potential instability. The record flows into gold ETFs indicate that more investors are seeking this protection. So with global instability, a weakening dollar, and stretched market valuations, the case for gold is clear. But how high can the price go? The world's top banks have their forecasts, and the next price target might be higher than you think. If these forces have already pushed gold past $5,000, what's next? According to some of the world's top financial institutions, this trend is far from over. Goldman Sachs recently raised its end of 2026 gold price forecast to $5,400 per ounce. They point to the same drivers: continued central bank buying and investors hedging against global risks. JPMorgan is also bullish, forecasting gold to average $5,055 in the last quarter of 2026, on a path toward $5,400 by the end of 2027. Their analysis projects a combined demand of around 585 tons every quarter from investors and central banks. A more bullish scenario also exists. Bank of America has suggested gold could surge towards $6,000 per ounce. They argue this rally is about deep structural problems with global debt that are not easily resolved. Analysts have also noted that if foreign investors shifted just 0.5% of their U.S. assets into gold, that alone could drive prices toward the $6,000 mark. The common thread in these forecasts is that the underlying trends pushing gold higher are not losing momentum. As JPMorgan's head of global commodity strategy, Natasha Kaneva, stated plainly, the long-term trend of official reserve and investor diversification into gold has further to run. The supply side of the equation strengthens the case. It is incredibly difficult and expensive to open new gold mines, so supply is struggling to keep up with structurally rising demand, a textbook recipe for higher prices. This suggests the price floor for gold has risen, with significant potential for further upside. These forecasts paint a clear picture of where institutional analysts believe gold is headed. Now, let's break down some practical considerations for navigating this new financial reality. Understanding these dynamics is one thing. Knowing how to respond is another. The key is to approach gold not as short-term speculation, but as a potential strategic component of a financial portfolio. First, it is wise to avoid a speculative mindset. Chasing prices after a major run-up is a difficult strategy. Instead, many view gold as long-term insurance for their wealth. The goal isn't to get rich quick, it's to protect purchasing power from being eroded by inflation and market volatility. There are a few ways to gain exposure. The most direct is owning physical gold, like coins or bars. This is a tangible asset held outside the digital financial system, though it does involve storage and insurance costs. A more accessible option for many are gold ETFs and funds. These instruments track the price of gold and can be easily bought and sold through a standard brokerage account. The massive institutional inflows in 2025 show this is a preferred method for many large investors. For those focused on long-term retirement, a gold IRA allows for holding physical, eligible gold within a tax-advantaged account, combining gold's properties with potential tax benefits. A common strategy investors use is dollar-cost averaging, investing a set amount at regular intervals, regardless of price. This can smooth out volatility and mitigate the risk of investing a lump sum at a market peak. Finally, perspective is crucial. Gold should be part of a diversified portfolio, not the whole thing. Most financial advisors recommend an allocation based on personal risk tolerance and financial goals. Balance remains key. Let's bring it all together. Gold's move past $5,000 an ounce is not an anomaly. It is a reflection of the current state of the global financial system. We've seen how geopolitical friction has reduced confidence, how the scale of U.S. debt is encouraging diversification away from the dollar, and how the world's central banks are making a historic vote of no confidence in unbacked paper money. This isn't just another rally, it's a fundamental repricing of real value in an uncertain world. The forecasts from Goldman Sachs, JPMorgan, and others all point to one conclusion. This trend may have room to run. The forces that brought us to a gold price of $5,000 are not diminishing, they are intensifying. The outcome appears to be a world where gold plays a much larger role in the preservation of wealth. This is the new financial reality. What are your thoughts on the future of gold and the dollar? Are you taking steps to position your portfolio? Let me know in the comments below. And if you found this analysis informative, please hit the like button and subscribe for more deep dives into the forces shaping our financial world. Thanks for watching.